Okay, this video is going to try to explain these relationships that you often see in a finance textbook, whether it be an introductory corporate finance book or an introductory investments textbook. And these relationships seem to be a bit of a mystery. They're often just presented without really a deep explanation. And my point of this video is I'm going to try to explain it two different ways. I'm going to give you examples, and then I'm going to show you graphically how to think about it. So let's look at these things. So when a bond trades at par, what this is saying, so you anchor on this scenario first. When a bond trades at par, in other words, it's a $1,000 bond that trades at $1,000. That means its coupon rate will equal its yield to its current yield, which will equal its yield to maturity. So the coupon rate is typically specified for a bond. The current yield is simply the annual coupon payment divided by the price. Okay, and so since the bond trades at par, the price is $1,000. It's the annual coupon divided by the price, which is the same as what the coupon rate is defined as. And it's also the point at where the yield to maturity equals the current yield and the coupon rate, because the yield to maturity is what the market is looking for in terms of a return given its risk. And if the bond is trading at par, there's no premium and there's no discount associated with the bond. And so the bond is paying exactly, from an investor's point of view, exactly what it should be paying. And so these three numbers line up. Now, when you have a premium, and this is where things get a little I think most people can get a handle on that. They get a problem when it comes to these two scenarios here. So when you have a premium, the coupon rate turns out to be higher than the current yield, which is higher than the yield to maturity. And then with a discount, the coupon rate is less than the current yield, which is less than the yield to maturity. Now, it seems like gobbledygook. Let's explain it first with an example, and then I'll give you a little bit more intuition from another angle. Okay, so here's where we start. Okay, so point of reference. Start with, say, just making it up, a 10-year annual bond, so it pays annually, so we don't have to deal with semi-annual stuff. It's an annual bond with a 5% coupon rate, and the yield to maturity is 5%. When that happens, the bond is not attractive or unattractive to investors. It's just right because the market demands 5%. This pays 5%. The bond trades at par. Okay? And so in that case, look, the coupon rate is going to be 5% because that's what basically I'm telling you in the narrative here. It's 5%. And how is that calculated? It's the $50 annual payment divided by the price of the bond, which is at par, it's $1,000. The current yield, well, that's the annual coupon rate divided by the price, which happens to be $1,000. And I'm telling you in the narrative here, it's a yield to maturity of 5%. So these guys line up. Now what we want to do is say, what happens when the bond trades at a premium? Okay, and so what I'm going to say is, look, we're going to assume when a bond trades at a premium, the way that happens is the market has to demand something less than a 5% yield to maturity, which is the coupon. So the coupon rate stays fixed. It's going to stay fixed at 5%. It's fixed over the life of the bond. So they anchor on that 5% there. Now the yield to maturity, let's say it drops to 4%. And when the yield to maturity drops to 4%, remember what that means. That means that this bond is paying off 5%. I should be pointing to this number. It's paying off 5%, which is attractive. The market only demands 4%. So this bond will trade at a premium. Okay? Which means you're going to take that $50 annual coupon payment, which is fixed, and it's going to be something higher than $1,000. And I'll just denote that as $1,000 plus. So what that means is this whole fraction comes down a bit. Oh, I'm sorry, goes, if this goes up, this whole thing goes down, and it goes from 5% to, in this case, 4.6, I'm looking here, 3%. Okay, so it was 5% here. It's dropped down because the denominator here got larger, and so the whole fraction comes down relative to what it was just up here. Okay, so there you see 4%, which is less than the 4.63, which is less than the 5 right here. So I just showed you this relationship. And what you see here, by the way, is you see that the yield maturity is moving more than the current yield. So the yield and maturity dropped by 100 basis points. The current yield only dropped by 37 basis points. Now, if we do a discount bond, again, the coupon rate stays the same at 5%. And let's say in order to get a discount, now the bond's trading at less than 1,000, that means the market is demanding something higher than the 5% coupon. So let's say it's 6%. The market is demanding 6%. That's why it's an unattractive bond and selling at a discount. The market wants 6, the bond only throws off or gives off 5%. Right? So it's selling at a discount, which means you take the annual coupon, which is fixed, and divide it by something that's less than 1,000. So I'll put 1,000 with a negative sign next to it, meaning that's less than 1,000, which means this number goes up relative to the 5% that we started out with. Okay, which again shows you that, look, you got 6% is greater than this number, which will be, I calculated this number to be 5.4% actual, and that number will be greater than the 5%. So again, I've just matched up with these different signs here. And so that is a numerical explanation. Now, let's go one step further. It won't take too much longer. And let's bring in the bullet curve. That's what I call a bullet curve. And here, this is going to be time on this axis. And here we have a coupon bond. This bond is going to be trading at a premium. And so in our example, 81.11 is the bond when it trades at a yield to maturity of 4%. So the way to look at this is when the yield to maturity is 5%, that's 5%, it implies the bond trades at par. If the yield to maturity suddenly drops down, you know that inverse relationship between yield to maturity and bond prices. Bond prices are now $1,081.11. Now, if the yield to maturity was instead 6%, then the bond's going to be trading at a premium because the market wants 6%, but the bond only gives off 5% in coupons. It's an unattractive bond. That bond will be priced at $926.40. Okay? Now, this point in time is going to be the maturity. Okay? So you start off with an $81 premium here, and this bond will slowly decay in value because you know the bond matures at $1,000, so it's going to sink down to $1,000 over time. And it'll tend to sink down a little faster towards the end. That's what the curvature there is telling you. And when you buy a bond at 926, you know it's going to mature for $1,000, so it's going to creep up, and you're going to get a capital gain here if you buy a bond at a discount. That's part of your yield. And here you're going to get a capital loss of a little bit each period. Okay? So keep in mind that your yield to maturity is like a total return that's made up of a capital gain yield plus a current yield, which reflects the cash flow of the bonds. And so what I'm saying here is, now look, if you have a bond that trades at a premium, you know you're going to have capital gain yields that are going to be negative. They're going to be down, right? And you also know that the current yield is going to be down also, which is the $50 divided by 1,081.11 cents, 1,081. So you know that's going to be down. And so the yield to maturity is down, which we know because we started off at 5 and now it's 4. And so we know the yield to maturity fell. But remember, the yield to maturity has two components. And it's basically a total return. You know, any asset has two components. It has a capital gain yield and some type of cash flow yield. With a bond, it's the yield to maturity is the total return. There's a capital gain component because the bond will increase or decrease in price. And then you have cash flow component. And so what happens is, notice that the yield to maturity falls because these two guys fall. That means the yield to maturity drops more than does the current yield, okay? Because you got this capital gain loss. So when you have this relationship, your current yield is going to be relatively sticky relative to the yield to maturity. So yield to maturity is going to drop more than the current yield. So there you have it. When you have a premium, this yield to maturity drops a bit. It's less than the current yield. Now, when you have a discount, the bond starts at 926, you're going to have a capital gain. So kind of drawing that relationship again is you're going to have a positive, you know, however you want to draw it with an up arrow or a positive. And you also have a positive or increased current yield. Okay, because the current yield will be 50 divided by the 926.11. So that'll be a high current yield. So what happens is you have a high yield to maturity, which is made up of these two components. But again, as you see, the yield to maturity is more flexible, goes up more than the current yield, and it goes up. Why? Because it goes up because of the capital gain. And so now what you see is, you see that the current yield to maturity goes up more here with a discount bond than the current yield, and so it's larger relative to the coupon rate. So there you have it. You have pure example to try to explain this, and then you can actually do it without numbers using the bullet graph here. So you technically don't need the numbers. I just brought them in there to integrate it, but you don't need to see the numbers. You can translate this picture into these three scenarios. That's it for this video.